After a powerful 4-week rally, many may be thinking that stocks are out of the woods. You may change your mind after you review these charts that make a powerful statement about risk versus reward. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In this week's video, we're going to cover some generic concepts about human emotion, the primary trend, and counter-trend rallies. Then we'll take those concepts and apply them to 21 different charts from around the globe and from different asset classes as of Friday, March 11th, 2016. As humans, we tend to have the same emotions, and we tend to make the same mistakes over and over again. For example, the stock market just made a new high. That might be a good time to become extremely bullish. But then after several weeks of wild volatility and price appearing to be headed for lower lows, we might say it's time to cut back. I can't believe it, price reversed on me. But the good news is now, stocks, they're going to the moon. Oh, this time it looks bad. This must be the beginning of a new bear market. We had a breakout, a failed breakout, and then over several weeks, we made a lower low, a lower high, a lower high, and a lower low, and it appears now that we're headed for another lower low. It's going to be ugly from here on out. Stocks must be headed to new lows again. Well, if it wasn't for the Fed bailing out the markets, I would have been fine. But the good news is now we have an established uptrend, and my guess is that stocks are going to continue to make higher highs, and I feel good about my positions. Oh no, here we go again. We've got a left shoulder, a head, a right shoulder. We just broke the neckline. Now, we were fooled here, but now a brutal bear market is on the way. You've got to be kidding me. These algorithms, they're out of control. The computers, they're running the market. But the good news is now we've made a higher high and everything looks good. Oh, this volatility, it's driving me crazy. But at least now we have a series of higher lows and higher highs, and we can relax a little bit after this. This is ridiculous. These markets are rigged. Well, from a glass half full perspective, at least after this mess up here, at least we now have an established trend. Well, we've rallied now strongly. Look how strong these trends are here. We made a higher high, and this rally has lasted several weeks, and that doesn't happen in an established downtrend. After a multiple week rally, it's probably time to get back in. Why wasn't I more patient? How does anybody keep their sanity with this? Well, at least now it looks like we've broken this downward sloping trend line. Looks like we may have made a higher high here, and now it looks like we're about to make a higher high again. Things are starting to look pretty good. I'm a little bit underinvested here. It looks like we're going to run for a while, so probably a good time to put some more money back to work. Well, that's it. I am never, ever investing in stocks again. I'm putting all of my money in defensive assets. We made a higher high here, and look at the conviction here, so it's probably a good time to maybe change my mind. Maybe I should sell some of those defensive assets and feather some money back in, or put my 401k back in the stock market. Now looks like a good time. Now we've made 3 lower highs and 3 lower lows, and every article I read is bearish, and it's telling me that a new bear market has already started, and this was a false dawn. I guess the best thing to do is cut back on stocks. Well, that didn't work. Now I'm confused as I've ever been. Well, my stocks, they're doing a little bit better now. This trend has lasted a long time. This is starting to look more and more like a bull market. I think I'll allocate X% of my portfolio to stocks and really just try to leave that alone. I'll kind of go into buy and hold mode with part of it. My timing is absolutely impeccable. Maybe I should cut back just a little bit on that buy and hold portion of the portfolio. Well, it seems like buy and hold has been the way to go, so maybe I'll allocate almost all of my assets now to buy and hold and just leave them alone because this has been crazy, volatile, very, very difficult. I know we're down a little bit, but I'm just going to leave it alone now. All of my friends that have been engaged in buy and hold have done very, very well over the past few years, and I think that's really where I'm migrating to. We'll just see if we can't hold on to what we have and just let it go. See, this is nice. If I just become a buy and hold investor, I'll be fine. Now, everything that I'm reading now is saying things don't look good, but then I read other things that say I'm better off just leaving it alone. I think I'm going to leave it alone because looking backwards, that has been the best plan. So let's just stay invested and hope for the best. I know the housing market is starting to get soft, but we just made a higher high, and look how steep this rally is here. It lasted several weeks, so the thing to do is just to leave it alone. Let's stay with the buy and hold approach. I think I like that better. I know this has lasted several weeks, but this just looks like a normal pullback. I'm going to let it sit. Well, I'm glad I did. All that bearish stuff that I was reading really didn't help out. We've rallied now for several weeks, and it looks like this is just a consolidation pattern, and most likely my buy and hold will do fine when we move higher again. Yikes. I just read 2 or 3 things from people that have been working on Wall Street for 20 or 30 years, and they're saying that this might be a new bear market. But I've heard that before, and we went on to make higher highs. I'm going to be a buy and hold investor. This is just a correction. Stocks always come back. Well, I guess all those 30-year Wall Street veterans that said we might be going into a bear market were wrong, because we've rallied now in the S&P 500 for almost 2 months, and you never see a multiple week or strong rally within the context of a bear market, do you? What? It's not possible for the stock market to fall that quickly. I can't take this anymore. This buy and hold thing obviously isn't working. They said it would work. It's not working. It's just time to sell everything. I'm just going to get out. Wouldn't you know it? The day after I liquidated, the stock market goes straight up. Well, the good news is everything I'm reading right now says that this is just a dead cat bounce or a bear market rally. So I'm just going to stay where I am. I'm too nervous to get back in, too scared. I'm not going through that again. Well, now it's too late to get back in. I'll wait for a better entry point. Well, this little exercise shows us how difficult and frustrating the stock market can be if we don't follow some type of disciplined approach. There are numerous ways to do that. Ours is just one way. And as you might imagine, a lot of people do give up on buy and hold near the lows, and then understandably, they're human. It's very, very difficult for them to get back in. A few takeaways here. Primary trend is down, primary trend is up, primary trend is down, and this is a new primary trend that is a bullish trend. Notice in all instances during a bullish trend, we get multiple weeks of corrections and consolidation, a multiple week correction here, several months of sideways activity here. During the bearish trend, a multiple week counter trend rally, a multiple month counter trend rally, a multiple week counter trend rally, all of them 100% retraced. Downtrend, multiple month. This is about 2 months of a counter trend rally in early 2008. It was eventually fully retraced. We get a multiple week rally in here and several bouts of volatility before the lower lows are made. How does the model look at this, and how do we simplify this emotional mess that we have here that is incredibly difficult for all of us to navigate? The model focuses on trends, and mainly the primary trend. So during this whole period where there was volatility, it had one thing in common. The slope of the 200-day moving average in red was bullish. When it rolled over here, it told us that risks were increasing, and when the slope was down, it didn't mean we were going into a horrible bear market. It did mean that the probabilities of good things happening were lower here than they were here. Then, during the dot-com bear market, there was a ton of volatility. In fact, there were 4 counter trend rallies during this period here that lasted 4 weeks or longer. If you're looking at trends, there was a constant during the entire bear market. The slope of the 200-day moving average never turned up, and then down here when the new bull market starts, it does turn up. When it turns here, it doesn't tell us that a new bull market is starting. It simply tells us that the probability of good things happening is higher right here than it was at any time during the bear market. Then during this bull market, similar concepts. There's a ton of volatility in here. The slope of the 200-day moving average never rolls over. And then when the financial crisis bear market starts to begin, it does roll over. And once again, when we're here, it doesn't predict anything about the future. It's simply telling us that the risk-reward ratio in growth assets or stocks in this case is much less favorable here than it was at any time during this bull market. In this case as well, and we're using this for illustrative purposes only, during the entire frustrating bear market, where there were 3 periods where a counter trend rally lasted at least 4 weeks, so 4 weeks or longer, the slope of the 200-day never turned back up. And then in 2009, when a new bull market starts, it turns back up. It's not always this easy. This period is good for illustrative purposes. The model uses the 200-day moving average, but it does not use it in terms of a heavy weight. It's not heavily weighted in the model. But we do use similar concepts like this. When we make decisions, instead of asking one question like this, which is the slope of the 200 up, yes or no, we ask 207 questions about trends from multiple time frames. And we back-tested them all. In fact, we back-tested closer to 400 different permutations and combinations, and we kept the best ones relative to our longer-term objectives. Having said all that, from a conceptual standpoint, I can't emphasize enough, I would not recommend using the 200-day moving average as your only guide by any means. However, we can see conceptually that when the slope of it is up, the probability of good things happening is higher. In fact, if we add stressful price back to the equation, we can see how looking at trends and facts can help us during these emotional and stressful counter-trend rallies that occur. So if we know from looking at this that the probability of good things happening is higher when the slope of the 200-day is up, and the probability of bad things happening is higher when it rolls over, then a logical question to ask is, in the present day, how does this one indicator that admittedly we're using for illustrative purposes only, how does it look today across numerous markets and numerous asset classes? Regardless of what happens in this profile, it is an unfavorable profile to put our capital at risk. We want to put our capital at risk when the math and the 207 questions tell us the odds are in our favor rather than the odds being against us. Moving on to 2016, if we simply look at the slope of the 200-day moving average, we can learn a tremendous amount about the health of the global economy and the current trends and the market's current risk-reward profile. This is a daily chart as of 2:29 p.m. on Friday, March 11th. We've taken noisy and confusing and stressful price out of the equation, and we're simply looking at the 200-day moving average. Based on this indicator and this indicator only, does this look like an uptrend or a downtrend? After 4 weeks of a rally, the slope of the 200-day remains right now firmly down. And I can't emphasize enough, we are not making decisions based on this 200-day. But the things that we do use to make decisions are basically saying the exact same thing. So this is emblematic of what we're seeing in terms of the data that's going into the model and the numbers that are coming out of the model. And all of that is based on facts and observable evidence. The concepts on all of these charts will be identical. The charts basically do the talking for us. All of these charts are as of Friday, March 11th, roughly 2:30ish. So they've captured the vast majority of the 4-week rally. The NASDAQ, you can see the trend rolling over. Small caps have rallied as well. How much impact on the primary trend? Right now, anything that's gone on in EWZ, Brazil, at least from this perspective and the hard data perspective on our time frame, looks like a counter-trend rally within the context of a well-established and ongoing downtrend. Oil has had a wonderful rally. Here's the slope of the 200-day moving average as of the close on Thursday, March 10th in this case. I don't even have to look, but if I looked at it today, it's not going to look much different by swapping out 1 day out of 200 days in this average. Has everything stabilized in China relative to the primary trend and FXI? The answer would be no, until proven otherwise. Emerging markets. This is the DAX as of the close on Thursday, March 10th. 200-day for foreign developed nations at 238 on Friday, March 11th. Notice this ETF was up 2.43% on Friday, and the slope of the 200-day remains down until proven otherwise. Financial stocks in the U.S. as of the close on Friday, March 11th. How does the primary trend look on the chart of would I rather own stocks or would I rather own defensive assets like bonds? This is SPY relative to TLT at 2:40 p.m. on Friday, March 11th. What does this slope tell us about the state of the global economy and the ammunition that central bankers might still have in their arsenals? Could this moving average turn back up as it did here? Absolutely, positively, yes. And if it does, the hard data, the facts, the rules, and the model will not miss it. It has not turned up yet. We are always open to change and bullish outcomes. If this does start to turn back up, then the math and the model will start to show more discernible and meaningful improvement relative to what we need to do with allocation adjustments. Can we find anything that looks like the primary trend is currently up? Yes, if we look pretty much at all of the textbook defensive assets, or if we flip this ratio over and look at defensive bonds relative to growth-oriented stocks as of 2:41 p.m. on Friday, March 11th. It's not all gloom and doom from a primary trend perspective in the ETF world. A diversified basket of bonds, AGG, 200-day, just made a higher high, and the slope is up. Now we're looking at an individual stock, Apple, AAPL, primary trend up, primary trend starting to look indecisive, primary trend has rolled over. A lot of everyday Americans don't particularly care for Twitter, and the market doesn't particularly care for Twitter's stock either. Consumer discretionary stocks tend to do well when the economy is stronger, and money managers tend to migrate toward consumer staples, defensive consumer staples, when they start to get concerned about future economic outcomes. You can see the primary trend has rolled over from bullish to bearish. Energy stocks, XLE. Very, very difficult to make the case that the primary trend in transportation stocks is currently up when we have a 200-day moving average that looks like this. The ECB will definitely help out European stocks. Hasn't helped out the trend in EWP just yet. What is the slope of this 200-day telling us about the aggregate perception of Italy's economy? A week ago today, the bulls controlled the short-term trend, and as of the close on March 11th, they still control the short-term trend. You may remember on Twitter we showed this 60-minute trend line here. As noted in trading for a living, when you have a steep trend line like this, after a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old trend line from below. What that means is price may want to go back up and touch this blue trend line, which means we would be making a visit above 2020 for that to happen. When that happens, you have a near perfect shorting opportunity, a combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. Of course, all of that is to be determined. S&P 500 daily, 3:25 p.m. on Friday, March 11th. We did close right in this area. We closed higher, so price is actually on this side of this line. We're basically still in striking distance of the 61.8 retracement, the 200-day moving average, and this downward sloping trend line here. The bulls are still in control of the tape, and if price wants to move higher, another logical level that we would be watching is this gap here that started the year. This is December 31st here. The low, the gap is 2043 on this side. The high on this side on the first trading day of calendar year 2016 was 2038. You may remember last year, 2039 was a good watermark. Price stayed above 2039 for 6 months. So this represents a possible area of resistance. The gap fill could be, or a gap retest, a possible area of resistance. If we attach this low and this low and this slope and move it up here, you can see for the most part it has bounded price, and it also comes into play in the same general area. Is it possible that price is going to move higher? Yes, in fact, it's probably probable until proven otherwise. This counter trend rally is still in place, and it will remain in place until proven otherwise, just as the downtrends that we've just shown you, the primary trends, are still in place. Notice this is a counter trend rally within the context of an ongoing downtrend. Right now, this counter trend rally still looks very similar to this counter trend rally. That absolutely, positively might change. It hasn't yet. The data in the model has picked up a little bit. The ETF scoring system is basically telling us the same thing. On Friday, part of the ETF scoring system uses those 207 questions about trends. We scored our current positions and compared them to the highest scoring equity ETFs. We cannot find one equity-based ETF, with the exception of the one we already own, that scores higher than our current positions. Therefore, from a probability perspective, our current positions still offer, based on what we know as of Friday, March 11th, a better risk-reward opportunity than swapping them out for positions that are still clearly in primary downtrends. When the data changes and if the stock market wants to go on to make new highs, the model will absolutely adjust. And if we go on to make a new high and then reverse, the model can handle that as well. Common sense tells us since the S&P 500 was the strongest and dominant market at the end of this bull market, it's possible that the leader may go back up, even in the context of a new bear market, and make a new high. I'm not saying it's probable, but it would fit the profile of your leader maybe trying to make one last hurrah. And if we close above 200-day moving averages and we hold above them and the slopes start to turn up and we're going to rally for 3 or 4 more years, which may happen, the data, the facts, the moving averages, the risk-on, risk-off ratios, they won't miss it. And the rules will require us to make adjustments. And those adjustments will be made at a much more rapid rate if we move higher from these levels here. I think a few weeks ago we said mathematically somewhere in the neighborhood of 2060 things would start to change more rapidly. We're getting there, and if we need to make changes, we will follow the rules. Because as we have shown, it is nearly impossible to navigate markets without some form of discipline. This red line is a lot easier to make decisions with relative to this wild and crazy and volatile and stressful black line, which is the S&P 500. On Friday, March 11, 2016, the S&P 500 did close above its 200-day moving average, which is observable evidence, and it is positive. However, at least three instances here within the context of an ongoing downtrend, price on the S&P 500 closed above a downward sloping 200-day moving average, and you can see here we kissed the 200-day here during a downtrend in 2008. Remember last week we talked about the Federal Reserve Board and liquidity are really what drive markets. Many of you have probably seen similar studies. This one was posted on Yahoo on Friday. The title, "The Fed Caused 93% of the entire stock market's move since 2008. The bull market just celebrated its 7th anniversary, but the gains in recent years, as well as the recent sputter, may be explained by just one thing: monetary policy." You can look at the analysis by Googling this title. I've seen similar studies done and articles written over the past few months that draw very similar conclusions. We have a Fed meeting next week. The probability of the Fed raising rates is almost zero. The probability of the Fed discussing guidance and what they're going to do the rest of the year in some shape, form, or fashion is basically 100%. The market will be looking at the statement and guidance coming from the Fed. That interpretation may be bullish for stocks. It may be bearish for stocks. The present day, does it look more like this period, or does it look more like this period and this period where the odds were in our favor? These are the facts that we have in hand now. The Dow, the NASDAQ, and the S&P 500. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.